Aloha and welcome. I'm Glenn Kosgue and I am a resource connector with the Office of Economic Vitalization. Our mission is to connect businesses with resources to help them thrive and create good jobs for our community. Our Hawaii has always been full of entrepreneurs with great business ideas. The Talk Stories video will help new businesses and people thinking about starting a business with financial products they can use. Our guest today is Reid Chung, Vice President of HawaiiUSA. Reid has spent his entire career in the financial sector and has an in-depth understanding of financial products. Aloha, Reid.
Hi, Glenn. Good to see you again.
Okay, first question. Here we go. Can you define what is a startup?
I think you can't truly define what a startup is. I'll tell you from a bank's lending standpoint that any business that's less than 2, sometimes 3 years in business is still, in our eyes, a startup. And loosely defined, right? So we look at it as a startup only in the sense that we require those many years of financial statements, 2 or 3 years, to be able to finance you in your business, right? Anything else, anything less than that we view as still risky. But to the business owner, whether I'm a year or 2 years in business, sometimes it doesn't really matter, right? Sometimes I might be in the same phase. So from a startup point of view, from the business owner, a startup could be I'm still trying to develop my product or service. I'm still trying to hire employees and build my team, right? I'm still trying to find a physical location and where to operate, right? So right now I'm just operating out of my home. I'm still trying to grow my customer base or my relationships to be able to expand into different sectors or different areas. So the business owner might view themselves still in startup for a lot longer than 2 or 3 years, right? So to me, it's loosely defined. You can't really say what a startup is. There's no hard definition on if you are this, then you are a startup. But I'd say, just based on what I'm talking about from the lender end, right? Anything within that 2 or 3 year category, probably still from a bank standpoint, you're still considered a starting business. And a lot of times getting capital at that point is it's a lot more difficult.
So that means if it's a startup business, they might have problems getting a business loan because they don't have a business history.
Sometimes it's business history that holds the business owner back. Sometimes it's their personal financial situation that holds them back. Sometimes it's unfortunately the industry you're in, right? So there are riskier industries out there than others that are maybe more susceptible to things happening based on economic downturns or economic cycles. Construction is a good example of that, right? It's a very cyclical business, right? So when construction is good here in Hawaii, a lot of general contractors, subcontractors, they do really well. Cash flow is not that much of an issue. Staffing and getting the workers are not that much of an issue. But when you have a downturn where construction prices or costs are high, right? Less projects are being developed. It's a lot slower. And so for these companies, they struggle, right? So they have to really make sure they have the cash built up to survive those. So depending on the industry you're in too, right? The lender might view you as still in a volatile space where it's really hard to lend you. So it's not just one factor that I think holds a business owner back, but really a multitude of factors. It's hard to get financing sometimes.
Right, yeah, because I think most business, if they've been in business, owners think 1 year, 2 years, they're already set and their door's been open for that long, so they should be that should be good enough to get loans. I think that's some of the thinking I hear from some of the business owners.
Yeah, early on in my career, I financed a sandwich shop that was in downtown Honolulu. And the owners were a really nice family business. Within a year, they wanted to expand to another location on the island. And I remember thinking, because I was so young in my career, what's wrong with that? Like, we should be able to do that. And I remember taking their loan request to my underwriter and I got shut down. And the answer was because they haven't shown enough business history. And then you go back and you talk to the owner, it's like, but I've been in business a year. That's a long time, right? It's a long time. My family's gone through a lot. We put a lot into this in the last year. Who are you to tell me I haven't been in business long enough, right? So there really, to me, is a gap between the owner and the lender as far as, when the lender feels they're ready and when the owner feels they're ready to do these types of things. A lot of times you'll see these businesses start with self-financing. It's probably the most common way that they start a business, or venture debt, like they'll go out to their friends or family or investors and say, hey, invest in my company, invest in my business, right? So it's cheap financing. A lot of times the onus is put on the owner to be able to support all this, right? But it's risky. So imagine if you're the business owner and I take out a second mortgage or home equity to help fund my company. there's a lot of personal risk now I'm putting into my business,
Right.
right? So to me, I look at it as skin in the game. Like, oh, this owner has really committed, and they really know and believe that their product is going to grow or sell, or their service is going to grow or sell, right? That they put all of their personal assets behind it, right? It's, to me, a little bit more confidence, and maybe the owner knows and feels that they're successful what they're going to be doing. But from a lender standpoint, a lot of times that could be risky, because when we're trying to give out a loan, right, we want to make sure that there's collateral, like that secondary source of repayment we talked about in the first video, that's going to be there to be able to help support repaying the debt if the primary cash flow goes away. So it's almost like a catch-22, right? Like I put and invested a lot into my company to show you that I'm committed to this. But from the lender standpoint, well, there's no secondary source of collateral anymore, right? So because their assets are now tied up in the company. So there's a sensitive balance that needs to be played, and really understanding like when too much is too much. I've seen business owners that have taken out a massive amount of credit card debt to fund the business. Not exactly, to me, a smart way, because you're paying higher interest rate. Basically a higher interest rate loan, right, on money that you're using to finance a business. And if your return on investment that you're getting from your product or service is not enough to offset the interest you're paying, eventually you're digging yourself into a larger and larger hole, right? But oftentimes that's the way that businesses get financing, right? Because a bank or traditional lender wasn't going to come with a business loan when I first started my company, but Chase was able to give me a loan or a line of credit, right? So I think there's understanding there's different ways that businesses start when you're in that startup phase, and the most common I've seen is, you know, putting your personal assets or personal debt up to help start your company.
What about what I hear about at banks that they have like a line of credits? Would that help the business when they need the funding? Like let's say a restaurant has one of their equipments broke down and, you know, they need a replacement, so they can use a line of credit just in an emergency and just pay that back and you know, keep on going.
Yeah, I think that's a good point you brought up, because to me it goes back to the right product for the right purpose, right? So traditionally there are two types of products on the business lending space: a line of credit and a term loan, right? The line of credit is used for specific purposes, so short-term financing. Think of it that way, right? So I'm not going to put a piece of equipment or a piece of technology onto that line of credit, right, and then try to amortize it and the payment down, right? I need that line of credit to be open and revolving. So things like payroll, right, you might put on a line of credit. So real quick, every 2 weeks, I need to make payments, right? But my payments, my receivables coming in are not going to be in time. So I'm going to leverage that line of credit to be able to cover my payroll in the meantime while I wait for the receivables to come in and pay off the line. Right? So short-term financing for a short-term need. A big mistake is you see people put like, you know, term financing basically on lines of credit. And that to me is a misuse of that, because when you do need that short-term injection of cash, it's not going to be available anymore because you have a large debt that's sitting on there, right? And then term loans, obviously, you're going to do that for fixed purchases of vehicles, equipment, merchandise sometimes, or sometimes just injecting cash into the company because working capital is needed, right? So different reasons why you would use the two products, but really understanding what I need it for. I think it's really easy, you know, when you're first starting out, a business owner I've seen in the past will come in and say, I need a line of credit. Well, why? Because the rate's a little bit lower and I can revolve it, right? So I can use it and pay it back, use it, pay it back. But when you really dig into what they're going to be using the line for, sometimes a term loan is better for that. And then when you talk to your accountant or CPA, right, because you can amortize some purchases over a period of time, having that term debt is going to be more beneficial for you on your on your balance sheet than having the line of credit. There's another product that we didn't really touch upon, and it's the SBA loan products. And so a lot of startup companies will look to the SBA to help finance their startup endeavors. And the SBA works like this. They take a lender, like a local lender, like a Bank of Hawaii or My Credit Union, right? And they'll work with that lender to help guarantee the loan. So there's a guarantee that comes from the SBA. There's a guarantee that'll come from the lender. And a lot of times from a lender standpoint, the SBA takes off some of that risk, right? Because they're going to guarantee payment on a certain percentage of the amount. So from a business owner standpoint, it's almost like you have two partners now, right? You have the SBA and you have your local lender, which you're going to get the money through. So it's the federal government's way of injecting money into small businesses, right, through local lenders. But also helping to offset some of the risk for the lender and saying, hey, we're going to guarantee. Again, it's going to be industry specific, right? There are going to be certain industries that don't qualify. You're going to have to make sure that personally your finances are in order to qualify for an SBA loan, right? And then you're going to have, a business plan and things like that built for the business, which not a lot of owners starting out their company take the time to write out a business plan. So make sure you have some of these things in place, and then check with the SBA's website to make sure that you get all the documents you need filled out for the different types of loan programs you might want to go with down.
Well, I guess that's another way of going around. They can ask, have the SBA maybe guarantee the loan to the bank, the financial institution, and then they can get a loan from there.
Yeah.
But as you say, the main point is that their financial has to be in order for SBA or the financial institution to make that decision that if they do qualify for the loan or not.
Yeah. Think of it as like when you buy your first house, like taking out a mortgage, right? Like when I took out my first mortgage, I didn't realize how many documents I needed to provide, right? How many asset statements, how many years of tax returns, right? I need to put together. And all those things it's not the same, but it's similar with the SBA where there's going to be a lot of financial inquiry into you personally as well as the business. So making sure you have the right set of documents, you're incorporated correctly, you're registered with the state. That's a big one too.
Yeah.
Not a lot of businesses register themselves and then continually year after year pay the registration fee to keep their status active with the DCCA. So making sure that you're doing that, as well as your trade names that you build or you work under. So trade names also have to be registered with the DCCA. So making sure that you are also paying to keep those updated. I will tell you, there's a lot of loans that we've done that are funding pending, paying your DCCA fees or getting your trade name registered this year. So you want to do that because it may not seem like a big deal to you, but if your business is known under Aloha Inc. and everybody knows it, and then you don't register it, and then somebody else comes and takes that, right? There goes your entire business.
Yeah, just like the fiasco on the mainland.
Yes.
You can't use Aloha or a Poke name.
Yes.
Yeah, good example. Well, they got to keep their, the financial check, and also their license is always in check too. Great, thank you. What financial products are best for businesses that are in the startup stages?
So, kind of touched upon a few of them. So the SBA loan product might be a really good one, especially if I'm going to need startup financing to be able to build my business from the beginning. So that's a good one. Like I said, a lot of people finance through personal debt, right? So credit cards or they take out personal loans. While that's not advisable, it's understandable that a lot of people have to go that route. I would just tell the business owner, just be careful about that. Don't overextend yourself. Because at the end of the day, if the business fails, you're going to be stuck with all that personal debt. Right, so just make sure that one, your cash flow personally can help service that, but then two, you're not overextending and then putting a lot on the line to start your business, right? And then there are other bank products that could help. So there are business credit cards. So that's not oftentimes is that a common thought about when I think about taking out debt from a bank is a business credit card. But it actually could be a vital thing to the business. So if I know I frequently make payments for supplies or for merchandise to vendors, or I travel a lot for my business, having a really good business credit card with good rewards can really help the business owner, right? So I've seen business owners use this to their advantage where I know I'm going to travel. I'm a consultant. I travel a lot for my business. So I'm going to use my business credit card to acquire points or miles that I can use towards future travel to offset the cost. Right, so the business credit card will help with that. And so just leveraging that kind of tool to make sure it could still go back and pay me in the future at some point, I think is important. But that's another useful tool that a business owner might want to look at when they first start. There's not a lot of credit checks besides personal guarantees and a little bit about the business when you go after a business credit card. So it's a little bit easier to attain than a traditional bank loan.
Well, it's another venue of a way of thinking, but as long as they don't abuse the credit card, like your personal credit cards, for business. And, as you say, some credit cards offers, reward points, so they get credits, so they can make it payment a little bit easier for them too.
Yeah. Absolutely. Not advisable to keep balances on your credit card, pay it off every single month, right? But, make sure that you're leveraging it for the rewards that you can get from it, to be able to help you in your business.
Yeah, that's part of the reward programs, I presume, because if you use it properly and pay up every time, you should get points for that.
Absolutely.
Okay, and here, the big question, when would a startup be ready for traditional loans, lines of credit, or business credit card, and how do they get ready to apply for them?
It's a great question. I think, again, two perspectives on this. The owner might feel like I'm ready now. The banker, again, maybe because of credit guidelines or the relationship they built with the owner, might not feel they're ready yet. Right? But again, we're here to take instruction from the individual. We'll give advice, but it's really the owner that's going to start that conversation. Hey, I think I need this for this reason. And then that should start a dialogue, right? So I don't think there's a true time to say, hey, after year 2, you're ready to take out debt, right? But I think it depends a lot on the cash flow of the company. Depends on the circumstances in which you receive your revenue. It depends on what types of equipment or things that you need to grow your business. All those things are factors into when you're ready to take out debt. We financed a dentist once, right, who was buying out a practice and taking over an older space. So from the eyes of ownership, he was brand new, even though the practice had been around for many, many years, right? But when he bought into the practice, the equipment it was dated. So he needed to replace a lot of the equipment, right? So in his case, in that example, he was ready year 1, I need to buy new equipment, right? So I need to take out debt right away. How do I make that happen? Right. Then from the lender's perspective, we look at historical cash flow of the business prior to him being owner. Right. As a way to help offset some of the risk. But situations like that might be different for other businesses who maybe might not need to borrow to year 3, 4, 5, right? Because maybe the cash flow that's coming in, the revenue that they're generating, it's enough to sustain them. Right. And there's no need for them to take on additional debt. Right. So really depends on the company, really depends on the industry, even the individual and how they manage their finances. I'd say not business owners are the last resort, but I would say if there's a way to be able to use the cash flow that's coming in through revenue to be able to sustain and grow operations, that should be the first option. Right? Because then you're not using somebody else's money and paying somebody else to use that money. But a lot of times leveraging that at some point to grow your business is a good investment as well. Right? So when are you ready for a working capital line or injection into the business? It's really going to depend on when the owner feels they're ready.
Yeah. As you say, there's a lot of business lately that I visited that they want to continue the business, but they're getting old, ready to retire, but their kids don't want to take over the business. And, their only option besides that is to sell their business. And as you say, there's other people looking for those type of opportunities that take over the business. And from there, but to get financing for those kind of situations, as you say, they're a new business, startup business. So it's kind of hard to get financing, especially like a dental office. Those equipments are very expensive.
Yeah. I think the scenario you're talking about where you have a legacy business owner, like a mom and dad or a family business, and maybe the next generation doesn't want to sustain that business, right? So what do you do at that point? It's almost like succession planning within an organization. So how do you prepare for that? That's actually a really big topic, I think, among small business owners now, because generationally you have this next generation of workers coming up into the marketplace that don't really want to be owners, right? So a dentist is a really good example of that. You have a lot of dentists that are ready to retire, right? They're in the the retirement age or even older, but they have nobody to turn the business over to. And so when that happens, they're looking to sell, right? So what do I do? Do I sell to another dentist and have that person absorb me? Do I sell to a corporate entity that's going to package all these dental companies under one umbrella, right? Do I just fold my business that I built for the last 40 years, right? It's a really tough decision that the owner has to make at that point. But that's a real situation that's happening right now. And then for the buyer, if I'm a young dentist that wants to come in, right? How do I prepare myself then to buy a practice? Right? Am I ready financially? Is the business strong enough? And then I've heard that in dental school now they actually have business classes to give them acumen to be able to make financial decisions around, is this the right practice to purchase, right? So I think there are ways that you can prepare yourself on both ends, one for the exit and one for the entrance, right? But the bank should be there to help facilitate both. Right? And through that built relationship, be able to help you.
Well, that's great. Thank you very much for sharing the great information with our audience. We have more videos about small business funding and other essential topics. If you have any questions, do not hesitate to contact us at BCE, which is Boy Charlie Eagle, at honolulu.gov. Thank you, and we'll see you again.